In an interview, Donald Trump stated, "To me, the most beautiful word, and I've said this for the last couple of weeks, is the word tariff. This country can become rich with the proper use of tariffs." Over recent months, you may have noticed significant discussions around Donald Trump's economic strategies, particularly his focus on tariffs. Throughout his campaign, he strongly advocated for imposing substantial tariffs on nations such as China. Following his election victory, he has even suggested placing tariffs on Canada and Mexico as a means of pressuring them on issues like border security. However, one of his more unconventional proposals is the notion that if executed properly, revenue generated from tariffs could be substantial enough to eliminate the need for Americans to pay income taxes altogether. Although this concept may be seen as attractive initially, numerous critics have dismissed it as impractical, arguing that, in the long run, tariffs are likely to cause financial harm to consumers in the United States. What's the real story behind Trump's proposed tariffs? Could this strategy generate enough funds to support the nation, or will it exacerbate the financial struggles already weighing heavily on Americans? To evaluate this, we first need to explore how tariffs actually function and what they are. A tariff is essentially a tax applied by a government on imported goods. The government establishes a specific rate, for instance 10%, either on certain products or all imports from a particular country. When a business imports goods, they are required to pay this tariff, calculated as a percentage of the total value of those goods. For example, a 10% tariff on imports from China means that if a company purchases $100,000 worth of products, they will owe $10,000 in taxes to the U.S. government. This additional cost cuts into their earnings. To offset the expense, businesses often transfer the burden onto consumers by increasing the prices of these imported goods. Take, for instance, a company like Andrews Beverages that decides to import wine from Australia's Barossa Valley. Suppose the U.S. imposes a 20% tariff on Australian wine. If Andrews Beverages imports $1 million worth of wine, it would need to pay $200,000 in taxes to the government to bring the shipment into the country. This added expense significantly reduces the company's profit margins. To compensate, the company might increase the price of each bottle by 20%, raising it from $50 to $60. In the end, this means consumers face higher costs for imported goods. A reporter spoke to Donald Trump saying, "You are now proposing tariffs against the United States' three biggest trading partners. Economists of all stripes say that ultimately consumers pay the price. And now you have major companies like Walmart, Black & Decker, and AutoZone saying that any tariffs are going to force them to drive up prices for their consumers. If tariffs lead to higher prices for consumers, why would a government choose to impose them?" The reasoning can be boiled down to two key points that align closely with Trump's policies. First, tariffs generate income for the government. They function as a tax, and taxation is a primary way governments fund their activities. By applying tariffs on specific goods or nations, they can boost their revenue, which can then be allocated to areas like healthcare, infrastructure, or social security. This is why Trump has proposed tariffs as a means to potentially reduce or even eliminate income taxes. By increasing earnings from import taxes, there's less need to rely on income tax revenue. This approach aligns with another of Trump's core messages, prioritizing American businesses. He aims to leverage available tools to create a market advantage for local companies. With that foundation laid for how tariffs operate, the next topic to explore is Trump's broader plan, not only regarding tariffs, but also his bold proposal to potentially replace income taxes with them. The key question is, what exactly is he suggesting? First off, it's important to note that we're dealing with Donald Trump here, so these ideas are more concepts of a plan rather than detailed policies. He's made numerous statements to various audiences, leaving much open to interpretation. However, some recurring points in his rhetoric include the potential introduction of a blanket tariff of 10 to 20% on all goods entering the U.S., regardless of origin, a proposed 60 to 100% tariff on products from China, aimed at addressing trade deficits and perceived unfair practices in trade agreements. Threats to impose 25% tariffs on Canada and Mexico as early as Inauguration Day if they don't address his immigration concerns at their U.S. border crossings. Plans to enforce a 100% tariff on BRICS nations should they attempt to challenge the U.S. dollar by implementing alternative currency systems like BRICS Pay or BRICS Bridge. These proposals offer insight into his broader trade objectives, though their feasibility and outcomes remain to be seen. Trump sees tariffs as a powerful bargaining chip. By making imports significantly more expensive, demand for these goods in the U.S. would likely drop. This decline in orders would negatively impact foreign manufacturers and reduce exports from these countries, adding pressure on their economies. That's the strategy for now. Beyond using tariffs as a geopolitical tool, Trump also aims to turn them into a major source of revenue. He's even suggested that the money generated could replace income taxes for Americans. A pretty appealing idea, right? However, let's examine how feasible this really is. To do that, we need to dive into the numbers. As of October 2024, the U.S. had collected $629 billion in revenue while spending $1.25 trillion during the same period. A concerning imbalance, but that's another discussion. Of the revenue, nearly half came from individual income taxes, 40% from Social Security and Medicare taxes, and 32% from corporate taxes. The portion tied to tariffs or customs duties accounts for a mere 2.23% of the government's income so far this fiscal year. To match this smaller bubble to the size of the larger one, tariff revenues would need to increase by 22 times. However, the real obstacle isn't just the disparity in revenue, it's the relative size of the taxable bases. As the Tax Foundation explains, the real challenge lies in the amount of taxable income in each scenario. According to data from the IRS for the 2021 tax year, Americans reported nearly $15 trillion in individual income, contributing $2.2 trillion in taxes, with an average tax rate of 14.9%. Comparatively, total imports in 2021 reached $3.4 trillion, but this figure includes services not subject to tariffs. When focusing solely on goods, imports amounted to $2.8 trillion, generating $80 billion in tariff revenue at an average rate of just 2.9%. To replace income taxes with tariffs, the math is staggering. For 2021, tariffs on all imports would need to rise to 78.5% to match the revenue from individual income taxes. For 2023, with $2.2 trillion in income tax revenue and $3.1 trillion in goods imports, a blanket tariff of 71% would be necessary to achieve the same result. Surprisingly, the biggest flaw in this plan isn't just the ambitious 70% tariff rate. The real issue lies in its impact on U.S. imports. If such a steep tariff were implemented, imports would drastically decline, shrinking the taxable base. While the tax rate per dollar might rise, the total number of taxable dollars would drop significantly, ultimately reducing revenue. Research shows that import demand is highly sensitive to price changes. For every 1% increase in import prices caused by tariffs, the volume of certain imports could decrease by more than 1%. In practice, this means that while Trump presents tariffs as a lucrative revenue stream, the reality is completely different. Higher tariffs are likely to reduce imports, shrinking the tax base and having minimal effect on overall government income. This doesn't even account for the potential rise in tax evasion. With higher tariffs, businesses and individuals may resort to tactics like mislabeling goods, underreporting values, redirecting shipments to untaxed routes, or in extreme cases, outright smuggling to sidestep the costs. One of the major flaws in Trump's tariff proposal is its impact on everyday Americans. While it's marketed as a way to prioritize American interests and level the playing field, the actual effect of tariffs is to drive up prices for consumers. In the end, no matter what you choose, you're paying more as a consumer. This is why replacing income taxes with tariffs faces sharp criticism. It would unfairly burden lower-income Americans. Current data reveals that the wealthiest 50% of earners contribute 98% of federal income taxes, while the bottom 50% account for just 2%. However, tariffs inflate the prices of essential goods, which everyone needs. A price hike from $350 to $400 a week for necessities is far more damaging to someone earning $500 weekly than to someone earning $11,000. This highlights a fundamental principle of economics. Every decision has a ripple effect. As Warren Buffett wisely said, In economics, you can't stop at one step. You must always ask, what happens next? This really underscores the core issue with relying on tariffs as a replacement for income taxes. No matter the source, the financial burden ultimately falls on the American public. Many people find this frustrating, especially when examining potential revenue sources. There's a clear area where more revenue could be generated, yet the Trump administration remains adamantly opposed to addressing it. Specifically, this relates to corporate income taxes, which currently account for just 3.5% of total revenue. Under the Tax Cuts and Jobs Act, signed on December 22, 2017, the corporate tax rate was slashed from 35% to 21%. Now there's talk of reducing it even further to 15% for companies that produce goods domestically. Proponents argue that cutting corporate taxes fosters economic growth and encourages domestic manufacturing. However, many Americans question whether prioritizing corporate tax reductions aligns with broader efforts to create a fair tax system and reduce the financial strain on individuals.